I'm going to cover two general areas today. One is our performance on our strategies year to date and for the past month of June. I'm going to do this once a month. About 3 weeks ago, I introduced this idea and gave you my performance through June. Now it's going to be through July because people have asked me for that. Like, Ben, why don't you put this on here and tell us how you're doing? Well, first of all, I do put it on my website, reppondinvestments.com. And so you can go into the performance tab and whatever I'm telling you is there. Now, as I'm telling you this, the website person hasn't put it on yet. So within a few days, it will be up. But everything is there through June at this point, and it will be July. So I'll begin with that. The second thing is I will cover what's going on with the market. This is, last week the jobs report came out. There's implications to inflation, the economy, interest rates, labor, of course. And so the market reacted negatively. So I'll cover where that is. I've got some experts I'm going to play clips from to give you different points of view on that. So, hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is August 5th, 2025. So I'll begin with our performance, how we're doing. We have multiple strategies. The three most common ones that most people are in are, I'm going to start with those. I'll start with the one that's our high performance. This is the one that has the highest rate of return. It does have more risk to it, so I want to say that. But we record these in fact sheets and then we publish them. So these are all taken from live accounts. And this one, by the way, goes back to January of 2019. So it is about 6.5 years old. So the last 3 months, we have a rate of return of 30%. The last year to date is 21%, and the last 12 months is 18%. Since inception, this is a 6.5 year period of time, 25.83%. It has a beta of 1.27. So in other words, the S&P 500 has a beta of 1.00, and so it is has more risk or volatility by 27% than the S&P 500. The same strategy without the leverage, without the volatility, is our what we call moderate momentum. The rate of return for 3 months is 15%, year to date 12%, and the last 12 months 12%. Annualized rate of return 13% since inception, and a beta of 0.64. And what that means is that it is taking 36% less risk than the S&P 500. So if 1.00 minus 0.64 is 0.36. So it does have some volatility, but not as risky as the S&P 500. So, and finally, our sector rotation strategy is our lowest risk strategy, and it has a lower rate of return. The 3-month rate of return is 6.45, year to date 8.35, 12 months 15.11, and since inception, our annualized number is 19.57 with a beta of 0.91. Even though it's 0.91, the drawdown since the inception has been, on a month-end basis, has been about 6.5% maximum drawdown. And that is quite unusual. That's why I call it our least risky strategy. Okay, so that's that. It will be available on the website shortly, and you can see that if you want to look at it. Okay, now I'm going to get into what's going on with the economy. What happened last week was the jobs report came out, and that was negative. Also, what came out was the The Fed announced no change in interest rates, and that I think that was expected. But then the comments behind that were they made an adjustment to the last 2 months of data, and those were also revised downward. And I think it was the latter that caused the pullback in the market. Market came down on Friday quite a bit, but I'm recording this. Actually, it's going to be published tomorrow, Tuesday the 5th. I'm recording it on the 4th, and as of right now, the market is up substantially. So it's been, and our strategies are up quite a bit. So it's been interesting that while the market reacted negatively for one day, probably rightfully so, it bounced back today. So that didn't surprise me, actually. So I'm going to begin by playing Lance Roberts. Adam Taggart interviews Lance Roberts, who has a good perspective, and he will talk about his view on the stock market, the economy, and interest rates. Here's Lance Roberts.
Is it time for the bears to just put on their horns? Is it time to just love the bull market and just get comfortable with it?
Well, that would be a great thing to say like 2 months ago, but as we've been talking about for a while, the market's set up here for a decent correction. So the bears are going to have a bit of a victory lap potentially over the next month or so. Markets are down nicely this morning. We're down about 1.75%. It's ironically, I just posted a chart this morning on X talking about the stretch of days that we've had, so trading days in the market we've had so far, which without a plus or minus 1% move. And that was getting to be a pretty long stretch. These are called buying stampedes. It's where markets just kind of go up every single day, and it's called a buying stampede. Normally, buying stampedes last about 15 trading days on average. So we're at 25, 26 trading days. So that's a very long, push. And so this morning, one thing we've talked about a lot recently is that low volatility begets higher volatility. And, we're on the first day of the new month. We just had a slate of economic data that's showing the economy is slowing down rather rapidly. And, which is surprising considering Jerome Powell's statement this week. He had to have the employment data going into that and, should have been cutting rates, but didn't. So here we are. We've got this, kind of good evidence that inflation is declining, economic growth is declining. That's going to have some implications to corporate earnings going forward. And so markets are kind of waking up to that this morning. But again, the markets were very overbought, very extended. We've had the longest stretch above the 20-day moving average since 1968. So, we're correcting that now as we speak. We actually cracked the 20-day moving average today. So, again, it was time to have a correction. We've talked about this over the last several weeks, take profits. And it's kind of got to be a bit of ad nauseum, like on our radio show every day. We're talking about, hey, take profits, reduce risk, rebalance your portfolio. We're going to have a correction. It's like the market just kept going up. And, it just takes time sometimes for these pullbacks to happen. And so we're having a bit of a pullback now. And it could very well last here for another week or so to work off some of these previous kind of overbought conditions.
So the four I'm going to play, Lance Roberts was one. The second one is Mohamed El-Erian. I love his perspective. It's always well thought out. And again, talking on the same issue, they do go into bonds some, but interest rates, inflation, economy, and stock market. So take a listen to Mohamed El-Erian.
For more, let's bring in Mohamed El-Erian, Allianz Chief Economic Advisor. And let's just start there, Mohamed, with your reaction to this move and just the your general take on the integrity of U.S. economic data and what it means for markets.
So, Mike, we've long known that we have problems with certain data. Its methodology, its fewer people are responding. And as Ayman just said, you estimate quite a few things, and then as you get the data, you go back and revise it. So these issues have been there for a long time and have been getting worse. And there's been a sort of very reasonable discussion about what do we do to improve data collection. there isn't much evidence that they are politically driven, all this. It's just the nature of the exercise and the fact that the data collection tools have not evolved as quickly as they need to evolve.
Right. So clearly challenges, as we've discussed, low survey response rates, or whatever, maybe the modeling of how you extrapolate the survey numbers to an overall estimate of activity. But there is precedent, I think, in other countries of people trying to massage the data. By the way, I think it's also important to note there are private sector sources of comparable data, right? We talk about the ADP report every month. It tries to get private sector payroll. So it would seem that there's everyone around the edges trying to triangulate these numbers. And so you would be able, in theory, to sort of check one against the other.
Yes, and it's really unfortunate because during COVID, we got very innovative when it came to estimating data. So we went from waiting for example, GDP data, which is really backward-looking and lagged, to looking at credit card data, to looking at traffic as other indicators. We have a lot of high-frequency data, and I think the sad news is that the official data collection process hasn't really taken as much advantage as they should from this high-frequency data that can make the revisions less violent. I mean, today, Mike, we've completely changed the view of the labor market. The revisions were so large that the 3-month average, moving average, came down to 35,000, which is the lowest number since 2021. So suddenly, you've got a completely different view of the labor market over the last 3 months than you had just yesterday.
So this is a kind of a panel from CNBC, and one of the people in the panel comments on Jim Lebenthal, and he is, I would say, on the optimistic side, the positive side, and so you can see that view of, and his point is, yeah, it's taken a hit, but it's going to correct. Don't worry about it. Things are just fine. And here we are on Monday the 4th, and the market is pushing up quite a bit. So I don't know if that's what he was referring to, but I think he was mostly referring to the economy. So take a listen to this.
Let's just get the macro set up. Steve, if you don't mind, if we can kind of characterize what we saw in the jobs report. Obviously an undershoot on job creation for last month, as well as these severe downward revisions. Unemployment rate sort of leaks a little bit higher, and it really did change the bond market's assessment of what's to come for the Fed.
I think all that's right, and it also probably changing the Fed's assessment of what's to come for the Fed. I think we had Raphael Bostic on. He said, "Look, this shows there's more weakness out there than we thought." And I kind of asked him that question. I said, "I wish that I knew what I knew when I had the meeting last week." And he said, "Well, I don't know if it would have changed it, but we would have been thinking a little bit harder." And I think the big story here, I don't know if we have this full screen available, Mike, but it's the 91% probability of a rate cut in September.
Yeah.
And we went into this meeting with below 50%. Look, we didn't have this data. Now, you might have intuited it. Maybe this tells you a little bit more about y'all should be trading on the soft data, because the soft data told us that tariffs had caused businesses to hold back on CapEx and on hiring. It also told us that there was going to be price pressure. We got that in the PCE numbers this week. So you have all of the things economists told you that were going to happen. They just didn't happen in stock market trading time. Right? It's all been over this period of time. I don't know how you guys would have made a trade on this, but all of this has come to pass, and there could be more that might come to pass.
Yeah, in fact, let's get right to that. Jim, obviously the setup matters for all these things, right? We had this really calm rally into the end of July, and I think in part it was based on a lot of things, but it was partly based on this premise that the economy was going to remain resilient so that we can withstand a wait-and-see Fed, and we're not begging for rate cuts. Does this change the equation? Look, we're due for probably some give back in August anyway, but how would you view it?
I think the most important thing of what you just said is we were probably due for some give back in August. And I've been saying that for a couple of weeks.
weeks. I mean, this to me seems like an echo of last year. It's almost the same thing, right? On a Wednesday, the Fed didn't cut. On that Friday, you got a weak labor report, and everybody freaked out. And it was almost laughable at the time. I mean, Steve, I don't know if you remember this, but that weekend, people were calling for an emergency rate cut. I mean, not sane people, but some people.
I'm usually not laughing when that happens, but
that was laughable.
Right.
And look, the point that I'm driving at here is I think we would all agree the economy is and has been quite resilient. I think we would all agree it's been one heck of a rally. And I said this, I think, on Wednesday, that there isn't a wall of worry to climb right now. Well, guess what? We're going to build a new wall of worry, and it'll be perhaps some indications or some fears of stagflation, right? PCE core a little higher than we'd like. The labor report a little weaker. Let me give the executive summary. Things are going to be just fine. If the Fed cuts in September, I mean, I don't think they really need to, but they probably should as a prophylactic. We had 3% GDP. We're getting uncertainty to decline meaningfully. If the tariffs are at 16%, that's less than feared, all right? Take the good. Take the glass as half full. It's less than feared. Companies know what to do. They can move forward.
And finally, this is a clip from, again, CNBC. Sarah Eisen introduces Raphael Bostic. He is the chairman or the president of the Atlanta Fed. Again, well thought of person, good perspective. He's an insider, so he's going to speak from the Fed's perspective. I think he in general agrees with the Fed and the position they've taken, and agrees with their position of leaving interest rates, at least for now, where they are. Prior to the Fed meeting, the interest rates were, the expectation of a rate decrease was, I think they comment on this, was 50% chance. It is now 91% chance of a rate decrease. And the market will, if that happens, the market will see that, I think, as positive. If they have that expectation and it doesn't happen, that won't go well. So, but the issues that they're watching are inflation, unemployment, and the economy, or you could say GDP growth. So take a listen to this piece, Sarah Eisen, and actually Steve Leisman and Raphael Bostic.
Welcome back. Sizable miss for jobs this morning, coming in at 73,000 in July with sharp downward revisions. That might be the bigger story for May and June. President Trump lashing out at Fed Chair Jay Powell on Truth Social, of course, after the report, telling him to drop the rate. Joining us now exclusively is Atlanta Fed President Raphael Bostic, along with our own Steve Leisman. Good morning, Steve.
Good morning, Sarah. Let's get right to President Bostic. Good morning, President Bostic. Thanks for joining us. I'm going to start in the obvious place. Does what Sarah just said, the number this morning, along with those hefty revisions downward, change your view of the employment market, to change your view of the economy, and your view on the outlook for rates?
First of all, good morning, Steve. It's good to see you and Sarah. It's been a while. Here's what I would say. It's something that is definitely true. The numbers today were significant, and I agree with you that the revisions downward in the previous 2 months were perhaps the bigger story. Look, we've now seen with these revisions a real clear signal that employment markets are slowing down in a significant way. I would say off of pretty solid levels before. So the question that is in my mind is really, to what extent is this a one-time move down that will persist over time? Or is this something that we will see where the labor markets will return back to their basically waiting to see where things are? But going into this week, I thought that the risks to inflation were much greater than the risk to employment. Our inflation rate, core PCE, was at 2.8. It was not moving toward 2%. All the context we were hearing were saying that price pressures were going up, and labor markets were quite steady. Unemployment was at 4.1%. Wages were solid, and employment growth was solid. The numbers today and the revisions in an important way suggest that maybe the economy and the labor market is weakening more broadly than certainly what we're seeing in the 6th district. But that does also suggest that the risks to the employment side of the mandate are maybe coming more into balance with those in inflation, and that's something that I'll really have to look at as I think about the appropriate path for policy.
Raphael, there's the old song, I wish that I knew what I knew now when I was both younger or older. Had you had this data going into the meeting, would you have changed your view on what you ended up doing and supporting?
You know, I don't think so. There is still a lot of strength underlying the labor market. We do see that wages are not collapsing. So wages are operating in a way that we typically see in a solid labor market. The unemployment rate, as many have noted, is still at 4.2%, which is below full employment measures in many metrics. And I still am not hearing from businesses that they're on the verge of letting go a lot of people. So in many regards, the labor market still looks good. Look, even over the 12-month period, the annual job creation rate is still over 100,000 jobs. So in many ways, this is about slowing down. And now the task we have is really to figure out to what extent is this slowdown likely to persist and get us into a more troublesome position. But we don't know that now, and that's something that I'll be working on over the next 2 months.
Raphael, I know it's only a couple hours and change past the number coming out, but we had you penciled in, and I'll underline penciled because you don't make a firm commitment to your forecast. Had you penciled in for just one cut this year? Are you still in that place?
Well, you know, I don't really change those things until I get much closer to the meeting. So for today, yes. I do think that with new information, it's appropriate to rethink everything. And that's what I'll be doing with my team. If it looks like the labor market is weakening in a sustained way, such that the risks on that side have increased to be greater than the risks on the inflation side, then I'd be open to increasing the number of cuts this year. Today, I don't see that right now. Inflation is still further from its target than employment is from its, but we will just have to watch and see how things evolve over the next several months.
Okay, thank you for watching. If you have questions or comments, leave them in the comment section below.